Okay, so you want to own a housing business. Buy a building, collect rent every month, and watch the money roll in. Simple, right? Except it is not simple. Not even close. Because what looks like a landlord collecting checks is actually a multi-layered financial operation that touches real estate law, banking, insurance, employment, tax strategy, and government regulation all at the same time, every single day. And most people who walk into this business have no idea what they are actually walking into. Let us start from the very beginning. There is a difference between owning a house and owning a housing business. If you buy a home and live in it, you are a homeowner. You have an asset that might go up in value. That is fine. But owning a housing business means you are running an income-generating enterprise. You buy a property, or several, specifically to rent to other people and profit from those rents over time. That business can look like a single house you rent out, a small building with 8 apartments, or a sprawling complex with hundreds of units. The scale changes. The logic does not. At its core, a housing business earns money by charging people to live in a space you own. The difference between what you collect and what you spend is your profit. But the spending side of that equation is where most people completely underestimate what they are getting into. And the spending starts before a single tenant ever moves in. Let us say you want to buy a small apartment building, something modest, maybe 10 units in a mid-sized American city. The kind of property that feels approachable for a first-time investor. A 10-unit building in a secondary market like Columbus, Ohio, or Raleigh, North Carolina, might cost you somewhere between $1.5 million and $3 million to purchase. That is not construction. That is just the asking price for an existing building. Now, you probably know you need a down payment. For investment property, lenders typically require 20 to 30% down. On a $2 million building, that is $400,000 to $600,000 in cash, just to get the keys. But the down payment is only the beginning. Closing costs add another 2 to 5% of the loan amount on top. You are paying lender fees, title insurance, transfer taxes, recording fees, and prepaid escrow for property taxes and insurance. On a $2 million deal, add $30,000 to $80,000 to that pile. Then there are the renovations. Professional institutional operators, the companies that do this at scale, spend an average of $39,000 per home, getting a property into rentable condition before a single tenant moves in. That is the number for a single-family home. For a dated apartment building, expect more. By the time you have made your down payment, paid your closing costs, and made the property livable, you have probably deployed over $500,000 in cash. And you have not collected a single dollar of rent yet. Here is where it gets interesting because you put down, let us say, $500,000 in cash, and borrowed $1.5 million from a bank. You now have a mortgage payment every single month, no matter what happens. Whether your tenants pay rent or not, whether the roof leaks or not, whether the economy is booming or collapsing, lenders evaluate rental properties using something called the debt service coverage ratio. This is just a way of asking, does this property make enough money to cover what it owes the bank, plus some cushion? The standard minimum ratio that most lenders require is 1.25. That means for every dollar of mortgage payment, the property needs to generate at least $1.25 in income after operating expenses. If the ratio drops below that, the bank starts asking uncomfortable questions. And in a high interest rate environment, this calculation becomes brutal. Mortgage rates for investment properties sit higher than residential rates, typically 1 to 2 percentage points above what you would pay on your own home. On a $1.5 million loan at 7%, your monthly payment is roughly $10,000. That is $120,000 per year before you have paid for a single maintenance call, a single insurance premium, or a single hour of management. That debt does not sleep. It does not take vacations. And it does not care that your tenant in Unit 4 stopped paying rent last month. 2 identical buildings, same number of units, same construction, same age, can produce completely different results depending on where they sit. Think about 2 10-unit buildings. One is in a neighborhood where a major employer just opened a new facility. The school district is rated in the top 20% of the state, and the local population has grown 5% over the last 3 years. The other is in a neighborhood where the main factory closed 2 years ago, young families are leaving, and the vacancy rate for rentals sits at 15%. The building in the first neighborhood will almost always stay full. You can charge market rates. When a tenant leaves, you replace them quickly. The building holds its value and probably appreciates. The building in the second neighborhood is a different story entirely. Tenants are harder to find. You may have to reduce rent just to stay occupied. And an empty unit is not neutral. It is a financial drain. This is why professional real estate operators spend enormous effort analyzing population growth, employment diversity, school quality, and infrastructure before they buy anything. They call it a buy box, a set of specific criteria a property has to meet before it earns consideration. Getting the location wrong is not a setback you can renovate your way out of. The primary revenue engine of a housing business is rent. Every month, tenants pay to occupy your space, and that payment is your gross income. As of mid-2025, the national average asking rent in the United States is approximately $1,661 per month. That is across all apartment types in all markets. In cities like San Francisco or New York, a single one-bedroom apartment can command $3,000 or more per month. In markets like Oklahoma City, the same apartment might go for $900. But experienced operators do not stop at rent. They build what professionals call ancillary income, additional revenue streams layered on top of the base rent, parking fees. If you have a building with a parking structure or designated spots, you can charge separately for each space. In a dense urban market, a single parking space can earn $100 to $300 a month on its own. Pet fees. Roughly 70% of American renters own pets. Charging a monthly pet rent of $50 to $100 per animal, plus a one-time non-refundable pet deposit, adds meaningful income while covering the additional wear animals cause to starter units. Extra storage in a basement or utility space can rent for $30 to $80 per month per unit, URI billing. In older buildings where utilities run on one master meter, operators use a system called ratio utility billing to divide the property-wide water and electric bill among all tenants based on unit size and occupancy. Instead of the landlord absorbing that cost, it passes to the tenants in a proportional, legally compliant way. Studies show this also reduces overall utility consumption by between 13 and 18%, because tenants conserve more when they are paying the bill themselves, furnished units. A furnished apartment in a high-demand urban market can command a 10 to 30% premium over an identical unfurnished unit. The upfront furniture cost pays back quickly if the premium holds. The point is that a sophisticated housing business does not have one revenue stream. It has 5 or 6, all running simultaneously. Now let us talk about what is flowing out. The single largest operational cost for most housing businesses is the mortgage, the debt service we already discussed. But right behind it is a long list of recurring expenses that many first-time investors dramatically underestimate: property taxes. These are non-negotiable government assessments based on the assessed value of your building. They vary widely by location, but in a typical American city, property taxes on a $2 million income property can easily run $30,000 to $50,000 per year. Property insurance. And this is not the same as homeowners insurance. Standard homeowners policies are invalid for rental properties. Landlords need a special policy called a DP3, which is designed for non-owner-occupied buildings. The national average landlord premium runs approximately $1,500 to $1,500 annually for a single mid-market home. But for a multi-unit building, or for anything in Florida, Texas, or California where natural disaster risk is elevated, expect premiums of $3,000 to $8,000 or more for property management. Unless you plan to personally answer every maintenance call at 2 in the morning and personally show every vacant unit to prospective tenants, which is unsustainable at any real scale, you hire a property management company. They handle day-to-day operations in exchange for a monthly fee. The standard rate is 8 to 12% of collected rent, with 10% being the industry baseline. On a building collecting $15,000 a month in rent, that is $1,500 per month, $18,000 per year. Just for management, maintenance, and repairs. Everything in a building eventually breaks. Plumbing, electrical systems, appliances, roofing, paint, landscaping. Professional operators use a standard budgeting rule. Reserve 1% of the total property value annually for maintenance. On a $2 million building, that is $20,000 per year. And that is in a relatively good year. A major repair, a failed roof, a broken HVAC system, a burst sewer line can cost $20,000 to $50,000 in a single event. These numbers accumulate fast. Before a housing business earns its first dollar of profit, it has to clear all of them. Every single day a unit sits empty is money that is permanently gone. This is the concept professional operators obsess over. If your building has 10 units each renting at $1,500 per month, the gross potential rent is $15,000 monthly. But if one unit sits empty for a full 30 days, you lose $1,500. Not just from that month, but forever. You cannot go back and collect it later. At that rent level, an empty unit costs you $50 per day. Sounds manageable, but vacancy does not usually come alone. When a tenant leaves, there is cleaning, repainting, possibly new flooring, relisting, showing, screening new applicants, and signing a new lease. That process takes time, sometimes 2 weeks, sometimes 6, sometimes longer in a slow market. Research from property management firms puts the average total cost of a single tenant turnover at between $3,800 and $4,000 per unit. That includes lost rent during the vacant period, cleaning, repairs, advertising, and leasing agent fees. Scale that across a building or a portfolio and the math starts to sting. This is why retention matters. Keeping a good tenant for 3 or 4 years is worth far more than maximizing rent increases that push them out the door every 12 months. Here is a truth that new housing investors learn the hard way. A wrong tenant costs more than a slightly lower rent from a right tenant. The worst case scenario in this business is not a market downturn. It is a tenant who stops paying rent, refuses to leave, and forces you through the legal eviction process. Evictions in the United States are not fast. They are not cheap. The process, from the first missed payment to the moment a judge orders the tenant to leave, typically takes 2 to 3 months. In tenant protective states like California or New York, it can take 6 months to over a year. During that entire time, you are receiving no rent from that unit. You are still paying the mortgage, you are still paying the insurance, you are still paying property taxes, and you are paying an attorney to navigate the legal process. According to data from TransUnion, the average eviction costs a landlord around $3,500 in direct legal fees and court costs alone. Add the 2 to 3 months of lost rent, another $2,500 to $5,000 depending on the market, plus the cost to clean, repair, and re-rent the unit after the tenant leaves, and a single bad tenant can cost a housing business $7,000 to $10,000 or more before it is over. This is why professional operators screen tenants with rigorous standards. The universal benchmark is the 3 times rule. A tenant's gross monthly income must be at least 3 times the monthly rent. Someone earning $4,000 a month should not be renting a unit priced at $2,000 a month. The math simply does not work, and the risk of default is high beyond income. Operators check credit history, verify employment, review prior rental history, and search court records for previous evictions. Every hour spent on careful screening at the front end saves thousands of dollars of potential disaster at the back end. Here is something the passive income narrative never tells you. A housing business is not a one-person operation. The moment your portfolio grows beyond a handful of units, you need people, you need a property manager to handle tenant calls, coordinate maintenance requests, collect rent, handle delinquencies, and process turnovers. You need maintenance technicians, either on staff or contracted, who can respond to emergencies at any hour. You need a leasing agent or service to market vacant units, conduct tours, and process applications. You need an accountant who understands real estate taxation, because the tax side of this business is not simple. These are real employees and contractors with real costs. The property management fee of 10% covers the management company's overhead, but it does not cover the markup they charge when they coordinate outside repairs, typically 10 to 20% on top of the vendor's invoice. It does not cover the leasing commission for placing a new tenant, which can run half a month to a full month's rent per placement. Successful housing businesses are businesses. They have organizational structures, they have payrolls, they have vendor relationships. The idea that owning rental property is passive income is a myth that sells extremely well and delivers very poorly. Taxes in the housing business are complicated, but they can also be one of the most powerful tools an investor has. If understood correctly, in the United States, the federal government allows residential investment property to be depreciated over 27.5 years. That means you can deduct a portion of the building's value every year as a paper expense, even while the building is actually appreciating in market value. For a $2 million building where the structure itself is valued at $1.5 million, that annual depreciation deduction is approximately $54,000, an expense that shows up on your tax return but does not actually leave your bank account. This can dramatically reduce the taxable income generated by the property, sometimes to zero, even when the property is producing positive cash flow. Beyond basic depreciation, sophisticated investors use something called a cost segregation study, an engineering analysis that breaks the building into components and identifies which parts qualify for faster depreciation schedules. Appliances, carpeting, lighting fixtures, parking lots, these can be depreciated over 5 to 15 years instead of 27.5. Under rules restored by federal legislation in 2025, some of these components can be fully deducted in the first year. For a serious investor in a high tax bracket, these deductions can represent hundreds of thousands of dollars in tax savings, real cash that stays in the business and can be redeployed into the next acquisition. Let us run the numbers on that 10-unit building and be completely honest about it. The building collects $15,000 per month in gross rent, $180,000 per year. But gross rent is not profit. It is the starting point. Assume a 5% vacancy and credit loss, meaning on average, across the year, about 5% of potential rent is lost to empty units and non-payment. That reduces the effective income to $171,000. Now operating expenses. Property taxes, $40,000. Insurance, $10,000. Property management at 10%, $17,100. Maintenance and repairs, $20,000. Landscaping, utilities in common areas, pest control, and miscellaneous, $10,000. Total operating expenses, $97,100. Net operating income, what the building earns before paying the bank, is $73,900. Now the mortgage. On a purchase price of $2 million with a $500,000 down payment, you borrowed $1.5 million. At 7% over 30 years, the annual debt service is approximately $119,800. Subtract that from the net operating income of $73,900, and you have negative cash flow of $45,900 per year. That is not a typo. At current interest rates, a competently managed, well-occupied 10-unit building purchased at a standard market price in a mid-tier American city can produce negative cash flow in year one. The math simply does not work unless you put more money down, buy at a significant discount, or find a property with higher rents and lower expenses than the averages. This is not an argument against housing investment. It is an argument for understanding the math before you sign anything, because the monthly rent payment does something that stock dividends do not. It pays down the mortgage. Every month, a portion of that mortgage payment reduces the principal balance, and the tenant is making that payment, not you. Over time, the loan shrinks. The equity in the building grows, and that equity belongs entirely to you. On a $1.5 million loan, in the first year, approximately $35,000 of those mortgage payments go toward principal reduction. By year 10, that annual principal paydown grows to over $50,000. Over 30 years, the mortgage disappears entirely, and you own a building outright that someone else paid for month by month over 3 decades. Meanwhile, real estate has historically appreciated at a rate that keeps pace with or exceeds inflation. The Federal Reserve data shows U.S. residential real estate values have roughly tripled over the past 30 years in real terms in most major markets. Add the tax benefits, the depreciation shield protecting your cash flow from taxation, and the long-term picture becomes much clearer. The housing business is not primarily a cash flow machine in its early years. It is a wealth-building machine that operates over a timeline most people are not patient enough to use. Let us say year 1 goes well. The building is occupied. Cash flow is thin but positive. You get comfortable with the operations, build a relationship with a good property manager, and start thinking about the next acquisition. This is where housing businesses either grow into real enterprises or collapse under their own complexity. Scaling means taking on more debt, more tenants, more maintenance obligations, and more regulatory exposure all at once. The investors who do it successfully make one decision early. They centralize. Instead of buying scattered single-family homes across a city, they concentrate on apartment buildings where one maintenance technician can service 30 units in the same zip code, where one property manager can oversee an entire building instead of driving between 10 different addresses. The math of concentration is powerful. A property manager overseeing a 20-unit building earns roughly the same management fee as one overseeing 20 scattered houses, but with far less travel time and far more efficiency. Maintenance response is faster. Leasing is more streamlined. Insurance can be bundled. Lenders view larger, stabilized multifamily assets more favorably and offer better loan terms. The companies that have built serious housing portfolios, some of which now own tens of thousands of units across the country, did not get there by buying one house at a time indefinitely. They got there by converting cash flow and equity from early properties into the down payments on larger ones, and by building management infrastructure that could absorb growth without collapsing. Scaling without infrastructure is how housing investors end up with 12 properties, no systems, and no sleep. The housing business has real risks. Some of them are dramatic. Interest rate spikes. Many real estate investors who bought properties between 2020 and 2022, when interest rates were near historic lows, are now trying to refinance those same properties at rates 2 to 3 times higher. The cash flow that worked at 3% becomes deeply negative at 7%. Operators who use short-term floating rate debt to acquire buildings are facing severe pressure when their loans reset, market corrections. When the broader economy contracts, unemployment rises, tenant delinquencies increase, and vacancy rates climb. The 2008 financial crisis wiped out thousands of housing investors who had over-leveraged during the years prior. Property values fell 30 to 50% in some markets. Operators with thin equity cushions were forced to sell at a loss, or simply hand the keys back to the bank. Natural disasters. A single fire, flood, or hurricane can destroy years of profit in a matter of hours. The insurance system exists for exactly this reason. But insurance has limits, deductibles, and exclusions. Operators in Florida who did not carry separate windstorm and flood policies discovered this the brutal way in recent years when storm damage exceeded their standard policy limits and the bills landed on them personally. Regulatory changes. Governments change the rules. The United Kingdom passed sweeping legislation in 2026 that abolished the ability for landlords to remove tenants without a formal legal reason, a change that dramatically altered the risk profile of owning rental property there. In Ontario, Canada, rent increases for existing tenants are capped at 2.1% for 2026. In California and New York, eviction rules are so complex and timelines so long that many professional operators avoid those markets entirely. Understanding the regulatory environment you are entering is not optional. It is the job. Compared to other investments, housing occupies a specific place versus stocks. Over the very long run, residential real estate and equity markets have produced similar total returns. Roughly 7% per year in real terms, according to comprehensive historical research covering 16 advanced economies over 145 years. But real estate achieves those returns with lower volatility and without the 30 to 50% drawdowns that stock markets periodically deliver. And real estate lets you use leverage, borrowed money, in a way that public markets do not permit for most investors. Versus bonds, no comparison. Housing wins on return. Always has. Versus starting a traditional small business. A restaurant, a retail shop, a franchise, these carry higher failure rates, no underlying collateral, and no long-term appreciation of a physical asset. Housing, even in a bad year, sits on land that holds value. But here is the honest answer to whether housing is worth it. It is worth it for people who treat it like a business, who understand the financing before they sign, who screen tenants carefully, who maintain their buildings proactively, who keep cash reserves for unexpected repairs, who build a team as the portfolio grows. It is not worth it for people who think it is passive income, who undercapitalize, who pick the wrong location chasing a cheap purchase price, who ignore maintenance until it becomes catastrophic, who do not understand the lease laws in the states where they buy. The gap between those two groups, between the housing investor who builds generational wealth and the one who loses everything, is not luck, it is preparation. Here is what the best case looks like. You buy a 12-unit building in a high-demand secondary market. You put 30% down, which gives you a lower loan balance and a more manageable debt service. The building is fully occupied from day one. Rents are slightly below market and you gradually move them up over 3 years. Net operating income exceeds debt service by 15%. After the mortgage is paid, property taxes, insurance, and management fees are covered, you have a small but positive cash flow, maybe $12,000 to $18,000 a year. The building appreciates at 3 to 4% per year. Your tenants collectively pay down $80,000 of your mortgage over 10 years. In year 10, the building is worth meaningfully more than you paid for it, and your equity is substantial. Here is what the realistic version looks like: same building, same city. But interest rates are higher than you modeled, and one of your 12 units sits vacant for an average of 60 days per year due to turnover. A pipe bursts in year 2, cost $38,000 to fix. Tenant in Unit 7 stops paying in year 3. The eviction takes 4 months and costs you $9,000 all in. Cash flow is negative most years by a small margin. You are injecting $3,000 to $6,000 of personal savings annually just to keep the building solvent. You are not losing the investment. The equity is building, the mortgage is shrinking, the asset is appreciating. But the dream of passive income, of checks arriving without effort, is simply not the reality. The gap between those two scenarios is real. It is tens of thousands of dollars per year in some cases. And the difference between them is not mostly luck. It is execution. That is the housing business. Not a mailbox full of checks. An operation that rewards people who run it like a business and charges everyone else a very expensive tuition for learning that lesson late.